Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about RINGCENTRAL INC quarterly report. RingCentral Inc. offers a wide range of cloud-based business communication services, including Unified Communications as a Service, UCaaS, Platform Contact Center Solutions for Omnichannel Engagement, AI-powered customer engagement tools, hybrid event solutions with AI-powered engagement tools, pre-configured phones, and professional services. The company serves various industries such as financial services, education, healthcare, and more. Its products are sold to enterprise customers, small and medium-sized businesses through resellers, distributors, partners, and global service providers. RingCentral Inc.'s stock price drop. A multifaceted issue the past year has seen a significant decline in RingCentral Inc.'s RNG stock price, plummeting by over 27.17%. Several factors have contributed to this downturn. Macroeconomic uncertainties and cautious enterprise spending have led to underperformance, while intense competition within the Unified Communications as a Service (UCaaS) market has taken its toll on the company. Currency fluctuations have also had an impact, with competitors like Microsoft, Zoom, and Cisco advancing their AI-driven communication technologies. Disappointing Cone 2025 guidance and lowered full-year 2025 revenue projections further exacerbated the decline. Despite exceeding third-quarter earnings estimates, the reduction in fourth-quarter revenue forecast contributed to the stock's slide. These interconnected factors have cumulatively led to RingCentral's stock price drop, highlighting the challenges faced by the company in a competitive market. The primary drivers of revenue growth or decline are multifaceted and influenced by various internal and external factors. Key drivers of growth include effective customer acquisition and retention strategies, successful technological innovation, and strategic partnerships. Companies must also navigate the regulatory environment, manage marketing efforts, and invest in infrastructure to support growth. On the other hand, potential drivers of decline include loss of revenue due to delayed or canceled orders, substantial fines for noncompliance with regulations, and increased costs associated with compliance efforts. Additionally, restrictions on ability to compete in certain markets and negative impact on reputation can also contribute to revenue decline. Overall, companies must carefully balance these factors to achieve sustained revenue growth and mitigate potential risks of decline. Net income and profit margins show significant improvement. The company's financial performance has undergone a significant transformation, with notable improvements in both net income and profit margins. In 2025, net income shifted from a loss of $51.1 million to a gain of $20.4 million year-to-date, YTD, while in the third quarter, Q3, of 2025, it increased from -$7.9 million to $17.6 million. Profit margins have also seen an upward trend. The gross profit margin rose from 70.6% to 71.8% in Q3 2025, and from 70.7% to 71.2% YTD 2025. Operating income margin, which was a mere 0.5% in Q3 2024, increased to 4.8% in the same period of 2025, while it rose from -0.7% to 4.2% YTD. The primary drivers behind these improvements are improved operating performance and higher subscription revenues. The company's ability to manage its expenses effectively has also contributed to this positive shift. As a result, the company is now in a more stable financial position, with increased net income and profit margins indicating a brighter future ahead. The company is generating a significant amount of positive operating cash flow. According to the financial summary, the net cash provided by operating activities for the 9 months ended September 30, 2025 was $468,438,000. This indicates that the company's operations are producing more than enough cash to cover its expenses and investments, resulting in a substantial surplus. The company's debt level has undergone significant changes. The current portion of long-term debt has increased from $181,252 to $623,798, while long-term debt has decreased from $1,347,881 to $633,112. This indicates a shift in the composition of the company's debt. In terms of interest expenses, there is a notable decrease. Interest expense for 2025 was -$13,940 compared to -$16,000 $393 in 2024, representing a 15.1% decrease. Contractual interest expense also decreased from $14,839,000 to $12,073,000. The total interest expense related to long-term debt decreased by $2.45 million for the 3 months and $2.15 million for the 9 months ended September 30, 2025. Overall, while there are some fluctuations in specific categories, the company's interest expenses have generally decreased, indicating a more favorable financial position. Management's outlook, focused on growth and efficiency, the company's management team is optimistic about its future prospects, driven by a strategy of growth and expansion into target markets and key verticals. They aim to increase customer base, boost usage among existing customers, and expand internationally. However, they also acknowledge the risks associated with investing in AI, which could lead to significant costs but potentially greater efficiency and growth. Management is aware of the company's reliance on third-party relationships, regulatory compliance, intellectual property protection, debt, and taxation issues. While these challenges pose a risk, management remains committed to navigating them while driving forward its growth strategy. The company's financial summary reveals 2 key aspects of its shareholder return strategy. Firstly, the company has actively engaged in share buybacks, indicating a commitment to reducing its outstanding shares and potentially increasing earnings per share for existing shareholders. Secondly, despite generating profits, the company has chosen not to distribute dividends to its investors, suggesting that it prefers to retain its earnings for future growth initiatives or other strategic purposes. Concerns about inventory buildup and supply chain disruption exist. There are valid concerns regarding inventory buildup and supply chain disruption. The potential for inventory buildup is evident due to lead times of up to several months, as mentioned on page 19 and page 67. This could result in a significant accumulation of unsold products. Furthermore, the risk of supply chain disruption is also present. Supply chain disruptions are highlighted as one of the risks and exposures on page 36, with potential impacts on supply chains noted on page 54. Additionally, cyberattacks from nation-state actors pose a threat to supply chains, page 59, while the loss of access from third-party network service providers could also disrupt supply chains, page 67. That concludes the financial summary for RINGCENTRAL INC. Feel free to comment below, and I will be happy to answer them when possible.